Hello, everyone. Welcome once again to this wonderful session. It's one of our training sessions for the CAF Mutual Investment Initiative. As you know, we had our launch for CAF Mutual Investment Limited 2 months ago. Today is the 15th of August, 2024. 2 months ago, we had a launch, and as our custom has been, we always try to provide information and training to educate our people and help them make informed decisions with regards to investment. In the past few weeks or days in Nigeria, we've seen banks, raising funds, raising capital for a number of things. For themselves. So, want to know? People are asking, should I buy? Should I not buy? And how does this connect to what we're doing? So today we are trying to provide clarity and information in that regard. So we have our guest in the house, Brother Adike Chooks, who is here with us to be answering the questions we'll be asking. And then don't forget, I just mentioned a while ago, our topic for tonight is capital raising exercise that is ongoing by Nigerian bank at this time in Nigeria. If you look at your screen, you probably see I have on my screen Nigerian banks are selling shares, understanding current public offerings and right issues by banks in Nigeria. Thank you all, everyone, and good evening to you, guests, Brother Adike Chooks, the BOT chairman of the CAF Investment Limited. You're welcome to the session, sir. Glad to have you.
Okay, thank you. Thank you, Brema. Thank you, everyone. Well, I believe we're a family, so nobody is a guest and nobody is, we're all hosting it together. Okay. All right. I want to thank you for the opportunity for this knowledge sharing session. I believe that it will be beneficial to all of us. I've been involved probably 10 years back during the 2005-2007 with capital market beehive activities. I was involved in the tip that package public offers and offerings, rights issues, private placements. When I was involved in investment banking. So I believe that we can just share knowledge. So first, because we don't have time, why are Nigerian banks raising shares at this time? Okay, so there are several reasons why an institution, a business will go and raise capital. So knowing that banks are highly regulated, primarily banks in Nigeria are regulated by the central bank, so you have, the tool with which central bank used to regulate bank, and one of them is capital adequacy. Without going too technical, capital adequacy is just saying that the banks are financially stable. Okay, so they can withstand economic shocks, like we've seen in the last this last financial year, the accounts being published. Nestle, their shareholders fund is said to have been wiped out. MTN lost about 760 billion naira. All those are different businesses, they can bounce back, but the bank cannot afford to lose its shareholders fund. When the bank loses shareholders fund, then the bank doesn't exist. Okay, and like what we saw in Heritage, that the government liquidated, the central bank liquidated nothing. So several reasons, but key among them, whatever is the reason, it is for financial stability or capital adequacy ratio being met. And sorry, I just want to just say a few things which may be a little technical. Nigerian banks play in international banking setting, so you need to have line of credit with some banks, so that your letters of credit you originate from here, they can have the comfort of providing confirmation. And then you also have some level of businesses you may want to have other banks maybe do on lending to you, maybe a project in Nigeria, like we saw Dangote refinery. Definitely there will be foreign banks, there may be local banks. Some of those local banks may need to draw from their line of credit with other banks. Nigerian banks also go out. I remember a time when Zenith went to do Eurobond to raise 1 billion. So you must have some. So one of the reasons is capital requirement, regulatory requirement. So this time around, CBN is asking the banks to show up their capital to make sure that the economic shocks and other things that has happened in the last 4 to 5 years, will not impact significantly on the ability of the banks to do their business. The second reason is that why you do that, that's the fundamental reason. Why they do that, it gives them opportunity to expand and grow as a business. So it's just like somebody who is doing business, you want to scale up. So you raise capital, or you go to banks to borrow. But in this case, they want to raise capital, which is the capital they are raising now is equity. It is what they call tier 1 capital. It is something that if anything happens, there are losses, economic shock, it can absorb those shocks without looking at who they are going to pay, who will be on their doorstep drawing and say, oh, you're my debtor, I'm your creditor. So the other one is also when they raise these monies, part of the growth is that they are going to increase their loan portfolio. You remember after the 2005 Soludo capitalization, banks were pursuing people up and down, consumer credit, this and that. So central bank may have all this figured out that if banks are able to raise their capital. Brema, can you share the Excel sheet on the capital, the current capital requirement, and then what the central bank is expecting the banks to do? So you see that the banks, the upper one, the upper table, and maybe you zoom it so that our brother can see. So can you zoom it? So you see that Nigerian banks are classified. They are stratified into various categories. So all the banks have branches, but all the banks are not equal. So the licenses, you have banks that are called international banks. So before now, with 50 billion, if you have 50 billion, unimpaired capital, you can open a branch or you can seek a license in another jurisdiction. So you have a number of Nigerian banks in Ghana, you have Sierra Leone, Kenya, GTs in Kenya, you have EcoBank across various West African countries. You have Nigerian banks in the UK. Some of them are doing merchant banking. You have Nigerian bank in South Africa. There's a Nigerian bank that's in France and in other jurisdictions. So those are called international banks. Before now, 50 billion is a capital requirement, but CBN is saying now it is 500 billion naira. Okay, and then now have the ones that are called national commercial bank. These are commercial banks in Nigeria. You don't have international bank, but you limit your operation to Nigeria. But you can have branches across the country. Before now it's 25 billion. They are now moving it to 200. They moved it, not that they moved it to 200 billion. Then you have the commercial banks that are regional. A bank like Wema and some other banks. Now, this doesn't in any way suggest that they are not strong. It's not how big, it is how fit. Okay. So even though when they are big, it becomes difficult to fail. However, smaller banks can also do, doesn't mean that they are not healthy. So the regional banks, the regional commercial banks before now is 10 billion, it's been raised to 50 billion. Then you have the merchant banks. Merchant banks don't do retail banking. They do project financing, some other kind of investment financing, and corporate banking, corporate financing, and they can syndicate deals and all that. So they don't need, so for national license, they needed before now 15 billion. Now it is 50 billion. And then there's the ones that they call it Islamic banking, the non-interest banking. So for those that are regional, they are 5 billion, now raised to 10 billion. Those that are national, from 10 billion to 20. So you can see that now when they have this money, what would they do? They
Okay, I'm not sure I can hear. Brother, okay, I'm sure probably it's a network glitch and he'll be joining us back shortly. If you're just coming into this session, I mean, this is a live recording. You're welcome to the studio. We are looking at a capital raising exercise by Nigerian banks, I mean. So, I mean, every one of us, you're probably already aware that in Nigeria today, banks are selling shares. Okay, I just saw a comment. Our sister says she can't hear anything. Please, can anybody hear me?
Yeah, I can hear you. What happened? The thing went off on my side.
Yeah, it must be a network glitch. So you can go on, sir. I'll just send welcome to everyone who just joined. This is being recorded. We'll make it available in the platform. Please go on, sir.
Okay. So the other reason why the banks can raise money, internally they may look at their balance sheet, it may be weak. Those financial experts may say in terms of a bank trade with money, so you need to have some level. The same thing as capital adequacy, financial stability. So if the balance sheet is weak, no matter how a balance sheet that is not healthy, they can strengthen it to be healthy by bringing in equity. So a bank can issue shares and then people put in money, and those monies are long-term investments. So in summary, Nigerian banks are being compelled to raise money so that they can be financially more stable, take on shocks in the economy, and be able to support our economy, support businesses, and have capacity to lend, strengthen their balance sheet. So that's the summary. I hope I didn't take a long time to explain this here.
Okay, thank you so much. Thank you so much, sir. So for everyone watching this video live or the replay, we have questions we're going to ask. You can drop them either in this live chat or in the platforms when we drop the video. We'll try to be as simple as possible. I'm going to ask questions like a layman who doesn't know anything about shares and all of the things we're discussing tonight. So to our hosts, our guests, even though Badike said he's not a guest, he's one of us, but on this show, sir, I got a message. I got a message from Zenith Bank today. In the past 2 weeks, GTA and Co have sent me one or two information, but today I want to read it. It's an SMS. It says Zenith Bank rights issues at 36 Naira and public offer at 36.5 are opportunities for good returns on your money. Visit the website to invest. So they're saying I should go get the issues and the rights. So what is the difference between rights and issues? Like I'm hearing this for the very first time. What is the difference between rights, issues, and public offer? Rather, right issues and public offer. What does it mean, the difference?
Okay, I will try to make it as simple as possible. Okay, and then I use very simple explanations as possible. So maybe we are for it to be a public company, it means that you have over 50 shareholders. So we are 50, let's say we're 100 shareholders, okay, and we have raised 1 billion as our capital. So people brought in money and their shares are proportionate to the monies they brought, and we're doing business. And then the regulator now say increase your capital to 2 billion or 5 billion. Maybe when we did the 1 billion, we have made some profit, so we retained earnings. There is some level of revaluation and all that. So our shareholders fund is now 5 billion, but they now want to see that the one they call tier one, because that's actually what this one is. This one is different from the other fundraising. This one, they want your tier one to be 500 billion, not before that your shareholders fund is what, because currently Zenith Bank, their shareholders fund is about 2.3 trillion. Okay, that means that if you value all the things, the share premium, valuation, whatever thing that's retained earning that has gone, been on top of the investment that people have made, put all of that together, is about, but their tier one capital, which is monies that if you say anything happened, that's where the shock will be absorbed in, attributable to shareholders, not the bank's balance sheet. It's less than 500 billion. That's why they are doing this. Now, if we want to go to the market, if you look at CAMA is the document that says company matters, it guides it. So most companies, including banks, if you want the current shareholder, they have rights. Okay, so if you're going out to bring in new people, the current one, they have what? Rights. So you must offer them rights to bring in money. Now, over and above what that right will be, they can now agree to say, okay, let's also bring in new people. I don't know whether I get so the 100 of us that contributed 1 billion as shareholders in ABC Bank. I'm using this simple example illustration. Now, Central Bank now say we want you to raise it to 5 billion, and we've offered us right based on what is in our memo and article of association as a, and then that right may get us to raise additional 5 billion, which will bring it to 3.5 billion. And then we will now offer people who don't have shares in our company, we will give them an offer. So this other one, we're issuing rights to people who are already existing shareholders. So the other one is that people who are not our shareholders, we are also issuing shares for them to buy. It doesn't also preclude the people who have shares. So existing shareholders.
Okay, I think we've lost our brother due to network. Can anybody hear me, please?
So if I have, okay, Brema, okay, you are back.
Yes, please. Sorry,
Hello, Brema.
Yeah, please proceed, sir. I don't know where you
are. Okay. So I don't know the much you had. I've been able to differentiate between rights and public offer. But I want to go into the next thing that should follow naturally as a question from an enthusiastic investor. We will now ask, if I have the opportunity of taking up a right in an offering like all the banks are doing, and then also I have the public offer I want to buy, which one should I, what should I do? Okay, so number one is that there's a discount to the rights issue. So if you're an existing shareholder and they've offered, you try to first of all take your rights. It's your right, it's a discount, so you're actually making more money. So most of the shares, most of the price of most of those of the shares in the market, for instance, if you check the current price of Fidelity Bank, I think Fidelity closed yesterday. They say they raised over 129 billion. I think they wanted to raise 120, either 127.5 or 129 billion. They raised it. Okay, so their price in the market is around 10 naira something, close to 11 naira. That's their share price in the market. But they are offering it at 925. So you can see as a right, okay, and then they are offering the public offer at 9 naira 75. So that's a 50 naira discount. So first of all, you take the one that gives you much better discounts. So if you have 1 million units of Fidelity Bank shares, the right is cheaper by 500,000 or thereabout, because it's 50 kobo. Now, then the other one is if you still have money, then you can now buy the public offer. Okay, that's so that should be the precedence. You take up your right before, but if you don't have shares in the company, what you are going to do is if you have money and you now have assessed the company, you can consider their public offer, you know, after evaluating other parameters in their prospectus. Okay.
I think this is very, very clear. As you were speaking, I was looking at my SMS from Zenith Bank. Obviously, the public, the right is usually cheaper than the public offer. I can see Zenith Bank has the right issues at 36 naira, while the public offer is 36.5. I think 0.5 difference. Okay, that's very clear. So let's move on quickly to the next question I would like to ask you, sir. So what are the factors that one should consider before choosing which bank to invest in, over the other ones?
Okay, can you show the slide again and show let me look at the slide that you saw. there are a couple of things to consider. Okay, so like I also mentioned before, size is not only the, so scroll down to the other table, the table below. There's a table below, scroll down. Okay, so financial institutions are not like other kind of businesses or other ventures. So size is important, but not the main thing to look out for. Okay, like I mentioned, Zenith Bank is has the shareholders fund of 2.3 trillion naira. There are some Fidelity has a shareholders fund of about 600 billion, and FCMB has 300 and about 330 billion in shareholders funds. So those are big reservoir of value. Okay, but if I'm going to do, those are not what to pitch one bank against the other. So for a bank, it may differ for a manufacturing company. It may differ for a trading company. So this analysis I'm making is, yeah, generally they may look alike, but for a bank, I may not go into a little bit of more detail into what makes this. So number one is that there has to be a review. If you look at the banks, they will give you their prospectus. And when they give you their prospectus, like we did the other time when we were doing our launch, when they give you your prospectus, you see their 5 years performance. And what they want to use it to do is, well, many nominal people may not do it, but for institutional investors, corporates, people that have people who are vast in investment and finance, they will appraise the financial statement. So what they will look at, three key things in the financial statement. Number one is profitability of the bank. So the business has to be profitable. Their return on equity, return on capital, return on whatever, return is a healthy return. So the bank is efficient in managing its balance sheet. Number two is asset quality. Banks make money from assets. They collect liability and they make money from assets. So the deposit you put in the bank is a liability to them, but they in turn use it to make money. So the loan they give is assets. So you need to look at their asset quality. Okay, what is the non-performing loan ratio? What is their return on interest? You know, and all those kind of things. Okay, so that's number two. Then number three is their capital adequacy ratio. So very, very, very important. So capital adequacy ratio, you will now see if they have sufficient capital to do the business they are doing, or they've already started over trading. They are living on life support. Okay, those are in terms of financial performance. The second thing is to look at the quality of their management. You know, so that gives you quality of their management and also succession planning. If anything happens, is there any person who is a key man there? If he's not there, will the bank survive? You know, and all that. So those are some of the things you look at generally. Then you now come down to what have they said in the prospectus is their plan, their growth plan. How they what areas they want to make more money. Okay, that's one. And then you have what is the dividend policy. Even if the bank is making monies and all that, if they don't pay good dividend for you, it may not meet your, you know, cash. So I put in the matrix certain things. I said something about if you shift to the right, Rema. So you can see the average. There's something that I put there, dividend paid in the last 5 years. Okay, and then you can see also dividend yield. The yield is just 1%. You can see that in the last 5 years, on the average, okay, I think last year Fidelity did well, but if you look on the average in 5 years' time, that GT and Zenith outperformed the others. Access Bank followed closely. Okay, dividend yield on every year, their dividend, that is the yield, the dividend they are paying out compared to the price their shares is going at the time when the books are closed, or the income they have made and the share is you are having GT is 10.1%, Zenith is 9.04%, Access Bank is 7.5%. Now, there are banks that may have a policy of retaining some of the monies they make, maybe for growth. Others are paying out to their shareholders. Okay, so now, but if you're a financial analyst, what you look at will be, apart from this dividend yield, what their shareholders' value, is it reflected in the share price, the capital appreciation? Sorry, we have limited time to explain some of these things, but it is not just saying, oh, this one is selling cheaper, let me buy, or this other one is, or this ones have paid better dividends. There are also other factors you put in, like I've mentioned, profitability, asset quality, and those are things you, by the time you take the prospectus, look at it very well. Okay, now we have limited time. Now, because these things are not something that if you don't have the expertise, you would just put in so much money. That's why we have put together our mutual fund. That's number one, is that if you have 1 million to invest, or you have 100,000 to invest, if we put it in our mutual fund, we can invest it across multiple stocks and share the benefits and spread the risk. But if you have 100,000, for instance, that's big money for one person, or 1 million or 10 million, and use it and put in one share. It means that if anything happens to that the share, just like we're seeing the kind of capital erosion that FX risk cost Nestle, MTN, Lafarge, many companies that have dollar exposure last year, because of devaluation. Now, if it happens to that, I'm not saying even collapsing. If it happens, like 2 days ago, GT yesterday they had an issue with hackers, and assuming something like that happens, or a bank gets, garnish order, that confiscating part of their profit, of their balances, etc. But something happens, it may. So that's why it is better that we have a mutual fund where risks are spread. So even if anything happens, it's not going to happen to all your investments. It will just be a fraction of your portfolio that is affected. That's one. Two is that if you are investing in one stock, you are not diversified. Like I said earlier on, you're not diversified. Your risk is concentrated. I'm trying to rush all this because of our time. We said 30 minutes, and it's now 56 minutes because we started late. Okay, so there are a few other questions I will have wanted to answer, but it's very important that we note that direct shares is good for you to have direct shares, but it's limited. Only it gives you a limit of only that bank, so you can take the potential there, but you also bear the full risk. And price fluctuations, you may not have the expertise to manage that. But a mutual fund like ours can do that same thing, but across various shares, and across various asset class, that will enable us to get the return, but minimize the risk. Okay, so that's a summary of this question and answer. I don't know if we have specific questions. There are things I will have explained to us, which are very, very basic, but we don't have the time. I think the basic thing has been said. Exactly. So, Brem, over to you.
Okay, thank you so much, Brother Adekechukwu. If you're just joining us or you're watching the replay, Brother Adekechukwu is the chairman of the Board of Trustees of CAF Mutual Investment Limited. Recall, we launched this initiative 2 months ago. Today, the day of this recording is 15th of August, 2024. And we are here talking about the capital raising exercise by Nigerian banks. It is ongoing as we speak. In this session, we try to educate our people to help them understand what they're doing, what's happening in the country, in the financial sector. Even if you are investing in CAF Mutual Investment Limited, you need to know these things and know what your money is going into. So we've been able to answer a few questions. We've answered why are banks in Nigeria raising capital at this time? We've also answered the question to what is the difference between rights issues and public offer? Okay, he also answered the question when I asked, if you have an opportunity to invest in right issues or public offers, which should you go in or go for? And then the factors to consider before you choose any of this. And then he just, the last question right now, he was able to look at the difference between investing in these shares, for banks directly as an individual, or as against going through our CAF mutual investment initiative, the mutual fund initiative. Okay, so for the sake of time, we want to keep this very brief, like we've said. In the WhatsApp group, we're going to be continuing this discussion. And this kind of training, this kind of training session, educational session will not end. We'll have more of it in days to come. Maybe next week, we'll have 1 or 2 more. We ask everyone to join who can. Please join us live. If you cannot, no problems. It will be recorded and we'll make it available to the entire house. The reason is to make our people in CAF, CASTOR Alumni Fellowship, we want to make everyone knowledgeable in these financial matters so that we can make informed decisions. Thank you once again, everyone, for your time. This video will be dropped on the platform. Please, when you see it, kindly share to your generation WhatsApp groups or city regional WhatsApp groups so all our people can watch. Encourage them to watch it, and let's have the questions dropped in the main WhatsApp group. Beginning from tomorrow morning, we'll begin to answer them in the WhatsApp chats. Thank you so much for your time. Thank you, Brother Adikechukwu. We're glad to have you tonight. I appreciate you, sir. Thank you, my precious.
Thank you so much.
Thank you, Dikenified. Thank you, Engineer Ransom. Thank you, Botike Zagwara, Chisom Azubike, every one of you on the call. God bless you. Do have a great night. Bye for now.